So, guys, today we're talking about how to fire without making drastic sacrifices. And look, I feel like the fire movement. I love the fire movement. I think it's it's got a lot of attention. I think it's super interesting. I think that there's a lot of great stuff in there. But one of the biggest sort of issues that I see with some people that get deep into fire is that they do it in such an extreme way that you're sort of like sacrificing things that you actually value quite a lot while you're trying to get ahead. And to me, finding a bit more of a balance is really ideal. So what I want to go through today is how you can achieve the outcomes of fire. So financial independence, early setting yourself up for early retirement, or at least being work optional, but doing it without having to sacrifice anything that's truly actually important to you. Before I get into it, guys, just for the lawyers, please don't rush out and make any life-changing decisions. I strongly encourage you to seek out advice before jumping in. If you're making big decisions, you probably should be doing that anyway. And I also just want to give a big shout out to our event partner for today, Sharesight. I know a lot of you guys have registered in through Sharesight, so you're already across what they do. But if you're not already across Sharesight, for whatever reason, you've been living under a rock or something, they're basically a super powerful portfolio tracking software that allows you to check all of your investments in one place. And they've won a bunch of awards for their performance. They do a heap of stuff around dividend tracking and tax reporting, and super helpful. And they also have a free account that you can test it out with. So if you haven't already checked it out, would strongly encourage you to jump on in. And if you're checking out Sharesight and you have any questions, you can hit them up at their support@sharesight.com email address, which is up on screen there as well. Also, guys, and I'd actually love for the people online to pop into the chat if it's your first time at one of the Pivot Wealth webinars or events. I'd love to hear from you. Also, if you're an OG, I'd love for you to pop that into the chat as well. But look, if you're not already familiar with Pivot Wealth and what we're about, we do a heap of content. I can see a few OGs coming through in there. James. Darren, yeah, welcome back. A bunch of first timers here as well. So welcome to you guys. Yeah, so we do a ton of different content around similar sorts of themes, which you can check out. We've got upcoming events on our Eventbrite page, which you would have registered for this event through. There's also a ton of content on the Pivot Wealth website and socials. We've got a podcast called Mo Money as well. So if this stuff is up your alley, jump on in and you'll probably find a bunch more stuff that you get some value out of as well. Alrighty, guys. So look, getting into it, and I will just say before I get into this that I know that everyone's situation is unique when it comes to their money, but what we've found is that there are three really common challenges that come up when people are trying to make decisions around their investing, or things like setting up for fire or whatever the case may be. There is a few there, but the three biggest ones that we see is the first one is information overload, where it's like so many options, so much information. It's like you're like drinking from the fire hose, really hard to know who to listen to and who to trust. One of the ones that we're going to be spending quite a bit of time on today is that people struggle to really find the balance between how do you get ahead financially while living a lifestyle that you're happy with at the same time. And then the third one is FOMO and the fear of missing out, or FOFU, which is the fear of effing it up, basically the fear of making a mistake that you later regret. And what we find for a lot of people is that leads them to get stuck and almost sort of like paralyzed in a lot of cases, where it's not like you're doing nothing, but you're not really making the most of the money, and you're missing the opportunity to be getting more out of the money that you already have. And so what we've found is that there's actually three main areas that you need to get right. And I'm going to touch on each of these three areas today. If you want to really nail it with your money, which is your structure, and that's all about making it easy to save and manage your money and making it clear how much money you've got to work with when it comes to investing, fire, whatever the case may be. Your strategy, which is about figuring out the different pathways that can take you from where you are right now to exactly where you want to be with your money. And then the third is the solutions and the investments that you use to back up your strategy. And here you want to get reliable, consistent progress over time and avoid the chances of downsides and setbacks and those momentum killing mistakes. And so what we've found is that you need to get all three of these areas right, because if even just one of them is missing, it ends up dragging down on the others. And so to give you some examples here, like if you've got a great strategy and great investments, but you don't have a good structure, it's like you're working with a leaky bucket. It's also really hard to have a great strategy if you're not across, how your money is working and how much money you've got to direct to, the different strategy options that you've got. Good structure, good investments, bad strategy, leaving a heap of money on the table. Good structure, good strategy, bad investments, you're going to blow up your cash. So it is really the three areas that we need to get right. We are sort of focused in on this fire piece today, but just be aware from here, when you are trying to, put some of these ideas into practice, that these are three areas that you absolutely need to get right. And I just wanted to share one more model with you before we start getting into the content, which talks about like getting from essentially where you are today to this future state when it comes to your money. And essentially for every single one of you guys, and for everybody actually, that in the future, you're really going to be in somewhere on a spectrum with your money. Some people are going to be doing really well, some people are going to be doing really poorly, and then there's going to be a heap of people in the middle. But the thing is, when people think about getting from where they are right now to this future state with their money, they think about the progress like a straight line. But because of the compounding impact of time and money, which we're going to talk a bit about today, that it's actually like a curve. And so for you right now, if you're not 100% on track to end up exactly where you want to be with your money, you need to do some stuff and what we call jump the line. So you need to, crank up your investing a little bit or be a bit smarter with your tax or sort out your saving or ditch a bit of debt or whatever the case may be. And once you've done that stuff and then you're on track, then you just need to take the next step and the next step and the next step, which is easier because you're already like on the path. But the thing is that you see in this diagram here that the gap is the smallest right now. And if you wait, a month, a week, a year, what happens is that the actual gap and the jumping line becomes more and more difficult and more painful. And putting yourself in the best position can become completely unrealistic, completely impossible. And so, I hope for you guys that you get some great ideas as we go through today, but know that the power of an idea is in its implementation. And the only way that you're going to actually get ahead, and I'm guessing that you registered for this event because you wanted to, do better in an area or sort out a particular issue that you're facing or kill a bit of frustration or whatever. If you don't actually do something with the ideas and the knowledge that we cover, then one, you're going to have to work harder in the future to solve that problem. But two, it's not going to actually just happen on its own. Unfortunately, it doesn't quite work like that when it comes to money. So, and the easiest time to do that is right now. Alrighty. So I want to start with some of the basics of fire, and then we're going to get a little bit more tactical. So essentially, what's true? There's a lot of different labels given to like financial independence or financial security or whatever the case may be. But ultimately, our definition of this is that you've got enough money in investments that they can cover your ideal lifestyle level of spending. So it pays you a salary so that you're now not working or that you're working out of choice as opposed to necessity. And then you own your own home. So you've got a place to live and you own that home completely debt free. So to flip it around to say, when you own your own home and you've got no mortgage on it and you've got enough investments to pay you a salary that allows you to live the ideal lifestyle that you want, to me, that's the definition of real financial freedom. And it's a really important to be clear on that. If you're thinking about fire or trying to set yourself up for fire, it's really important that you're clear on what that actually means, like what you need to have with your money in order to do that, because then you can start working backwards and figure out, how to actually get there. And, is what you're doing enough? Do you dial up, down, or whatever the case may be? And so another really important thing to be aware, a really important concept when it comes to your financial independence and fire or just your money success generally is something called the 5% rule. And essentially what the 5% rule is it says that you can draw an income from investments of 5% each year without eating into capital. So what that means in human words is to say that if you've got $1 million of money, you should be able to invest that in a way that it gives you an income of 5% or $50,000 a year and gives you that income every single year for the rest of your life and inflation adjusted as well without you eating into your initial capital sum of the $1 million. Now, practically how that works, and this is a rough rule of thumb, I should just say that, but practically how that works is that um, the long-term return on the share market is about, it's like 9.8% in Australia. It's slightly higher in the US at the moment. And so if you've got $1 million and you earn a 10% return on it, just to use some round numbers, you should earn about $100,000 a year. If you then spend 50,000 of the $100,000 that you've earned, then you've got another $50,000 that you can leave invested or allow to continue to grow, so that at the start of next year you've got $1,050,000, and then that's going to generate you 50,000, 50,250, or whatever the maths is essentially on that. And so that extra little bit, the 5% that gets reinvested to grow your money, that's what gives you the inflation protection and means that you're not required to eat into your capital sum essentially over time. And we've got a comment here from Mike that says, is it 4% or 5%? Look, I both of those rules essentially work. A slightly more conservative estimate is 4%, but 5% is the number that we use. And look, I think that where the 4% number comes from is largely a US thing, where people talk about 4% in income, because with US companies and US stocks in particular, typically the income return that those funds generate is lower than what we see in Australia. In Australia, we've got a big superannuation system, a lot of self-funded retirees. And so the income return or the dividend payouts on shares in Australia tends to be a little bit higher. But you can see, for anyone that wants to nerd out a little bit on this, like I do, if you look at the 30-year return on the Australian share market and the US share market, you'll see that they both track pretty nicely around that 10% mark. And then you've got, so if you're spending 5% of the 10% over the long term, then you've got another 5% that you can reinvest and actually grow the money so that you don't eat into capital. So the 5%, another comment there that says, is 5% nominal or real? 5% is the actual nominal amount. The real part, though, comes from the reinvestment of the extra 5%. So it's 5% today, but then you'll be able to draw $50,000 in today's dollars from your $1 million this year. And then next year you'll be drawing 50,000 and a bit dollars, but that will be worth $50,000 in today's dollars. So it sort of ends up being real. I get that that's a little bit complicated, but that's essentially how it washes out. And so the other thing that is really important, and for some people, I feel like it sort of almost goes without saying, but just to say it so it's crystal clear, that your home, while it's lovely to have a great home, and I think it's important, particularly as you get older, to have, security around where you're living and the property that you've got, your home is essentially excluded from your investment assets balance because it's just a roof over your head. Your home, while you're living in it, isn't something that generates you any income. And so there's no return on that money. And so if you think about, financial independence or the ability to retire early, then you want to be looking specifically at your investment assets, your share portfolio, your super fund, any property portfolios, cryptocurrency, whatever those things are. Those are your investment assets that you can position in a way to generate you an income. And one thing that you want to make sure that you really get right is your balance between your own home and your investments. And I see a lot of people get this balance out of whack, and it can be seriously costly. And so to give you an example, if you've got say $5 million in assets, just to use some round numbers, you might think that you're doing pretty well. But if you've got $4.5 million of the $5 million tied up in your own home, and you've only got 500 grand in investments, you're going to be pretty far away from financial independence. Whereas on the flip side, if you've got a $500,000 home and you've got $4.5 million in assets, you're going to be well on your way, if not already at the point of real financial security. And so getting that balance right is really key. And for people, and I'll talk about this a bit more when we get into the planning approach that you can follow when it comes to fire. But if you're trying to set up for fire, you want to really get into your numbers. And so I've got a couple of examples here from a couple of our clients. This is client of ours, Luke. When we got to chatting with him, he had focused on his home, had a really lovely home set up, done a great renovation, super happy, family happy. But they really had limited investments behind him, and so he was earning a good income, but essentially trapped in there because there were no assets, no other investments outside of his this lovely home, which had quite a bit of value, sort of trapped inside it. And so, as we've been working together over the last few years, we've been focusing on how do we replace the work salary with investment income. Reducing risk around borrowing is another part, and using some smart debt strategies, which I'm going to talk about a bit in the next section. And basically, in under 3 years, he put himself in a position where he's on track to do this. And he almost didn't start because he thought it was probably too late. He works in sports and had a good income, like being a sports person, was coming sort of towards the back end of career, and yeah, it almost stopped him from getting started. But in a relatively short amount of time, he got a clear plan in order to do that. And yes, he is a footy player as well. Another one here, we got James. He bought an off the plan property because he was told to get into the property market sort of ASAP. And then he got a bit of a windfall from an insurance payout. This full story is actually on our podcast for anyone that's interested in listening to it. But when he wanted to set up for early retirement, but when he started looking at his options, again, the conventional wisdom, and everyone was telling him to go and buy his own home and get that little bit of security and lock it down, which he could have done and could have done that relatively comfortably. But when we got into the numbers, we realized that it actually would have a big drag on his ability to invest and get ahead. So after looking at it and understanding the pathways forward, he chose to rent vest so that he could secure his capacity to invest. And that allowed him to invest more on the side, bought a quality property, so he got some good leverage in place, also generated some big tax savings, which he could then loop back into his fire strategy and get things in place. And so he didn't own any property when we first started chatting. He's bought an investment property, about to buy another investment property, but basically got a long way to laying out his path forward. And again, sort of not listening to the conventional wisdom. There's a lot of different ideas when it comes to money, and some of them can be good. In fact, a lot of them are good, but there's only really one right path for you. So again, I'm going to show you when we get into how to plan around this stuff, but know that there are a lot of different ways to be right. The key is really understanding your numbers. And so when it comes to setting yourself up, like if we know that you need to be investing and building your investment assets to set yourself up for financial independence, then there's only a few options that you can actually use in terms of getting there. In terms of the traditional, typical investments that I believe are the ones that you should be thinking about most. I know that there's a whole bunch of weird and wonderful stuff out there, but the core ones, tried and tested, that work and that are the most reliable and consistent. We've got shares, managed funds, and ETFs. I put them all in the same bucket. You've got property, and then you've got crypto and startups and some of the more speculative type investments. And so I'm just going to talk through each of them in turn. Now, share investing is great and super powerful because when you invest into shares, you can start small, right? You can start particularly with, and when I say shares, I do mean like shares or funds or ETFs or micro investing. And so with in this bucket, particularly with like the rise of micro investing apps these days, you can start investing with as little as $5. You literally do not need very much money at all to get this started, and you can start small and then look to build on that over time. Now, the return that you get on share type investments over the long term, and I know that, the past doesn't predict the future, and I was never here, this never happened, but, the long term returns and those figures that I was talking to you about, 30-year returns on the Australian share market, they give us a pretty good indication of what the future is likely to look like. And so we know that, when you're holding money in cash savings, interest income is taxed, then it's eaten up by inflation. And so savings is essentially going backwards after taxes and inflation. When it comes to shares, because you're getting, on average, roughly like a 10% return each year, the returns are significantly higher than what you get on cash. And that allows your money to actually grow and compound. With share investing, it's also very flexible because you can start, say, a regular investment plan and say you're going to invest $5 a week, $20 a week, $50 a week, $100 a week, whatever the number is, $1,000 a week, like whatever that number is for you. And you can do that this week and next week and the week after. But if something happens in the week after that, your partner loses their job, you get hit with an unexpected bill, whatever the case may be, you can simply turn off the investing, meaning that the money is still there. And so it's not like property, which I'm going to talk about in a second, but once you buy a property, it's like you've got to make that mortgage payment month on month on month. It doesn't matter what's happening with your situation. And so you do have a lot of flexibility with this sort of investments. There are also share investments, shares, funds, ETFs. They're also very good from an income perspective. As we were talking about in that example about the 5% rule and those sorts of things, that's something that you can quite easily get from a share portfolio. You can't always get that, or you can't get that quite as easily from a property portfolio. And I've got some numbers to throw at you around that in a bit as well. And so long as you're consistent with your share investing, you can get some really powerful compounding over time. The next one is property investing. And property investing, I love property. I love shares as well. Both of them are definitely winning strategies. But the biggest benefit of property by far, and a lot of people get confused with this, is the power of gearing. So gearing just means that you're borrowing money to invest. Anytime you borrow money to invest into something, that's called gearing. And then we have like negative gearing. That means that if the cash flow of that investment is negative, the total cost, mortgage payments, property costs is less than the rent that you receive, that's called negative gearing. If the income that you receive, say the rent in the example of a property, is more than the mortgage payments and all of the costs, then that's called positive gearing. But the tax implications of that are powerful, but it's the gearing part that makes the biggest impact. And I've got an example to share with you in a sec. But property investing is something that really supports you when you're building your wealth and building towards FIRE and your financial independence. The downside of property investing is particularly when you first buy a property is that most, quality premium blue chip type properties, it's going to cost you more than it makes you for the first handful of years. And so there's a cash flow impact there. And that ties into your risk management, which is really crucial. But the outcome, and I've just got an example here showing investing, if you've got $100,000 and you're considering, do you invest that into shares or do you invest into property? In the bottom row here, we've got you investing $100,000 into shares based on a long-term return of 9.8%. You see that after 12 months, that $100,000 would grow to be worth about $110,000. After 10 years, that same $100,000, not adding a single dollar more, but reinvesting the income and profits and stuff that you're making, would grow to be worth about 265,000, which sounds great, right? Like you've made 165 grand in 10 years. Happy days. That is a pretty good outcome. But if you got that $100,000 and instead put it into a $500,000 property, you see that because you're starting with a much bigger base, you've got much bigger numbers here. So after 1 year, you've up 532,000. After 10 years, 937,000. And so the amount of money that you make following the property path, or the amount of growth that you get, is 437,000 on top of your initial investment, which compares to the $165,000 that you'll get if you invest into shares. And the more time goes on, you see that the numbers just get bigger and bigger. So 20 years, we're $1.75 million for the property versus 700,000 for the share portfolio. 30 years, 3.2 million compared to 1.8 million. Now, with the share path, you put in 100 grand, you've got $1.8 million. So you've made $1.769 million here, which is a great outcome. But on the property side, you've made $2.8 million. So it's a much, much greater amount. And this is what I mean when I say, when it comes to growing your assets, growing your asset base and setting you up to have the ability to retire, then property, so long as you're smart about how you do it, you manage your risk, you're smart with your planning, which I'm going to cover in the next section, then it is a strategy which is quite compelling in terms of the numbers. And yes, I will say, and I saw a couple of comments pop in here. This is a simple example. I don't want to bombard you, and I could get a lot more complicated, which is the sort of stuff that we do with our clients. It's a simple example. But you see that even funding, if you're negatively geared for the first 10 years, there's still a lot of room for you to be way, way ahead of where you would be with shares. And then the couple of comments there about dividends, then the dividends get reinvested here. That's part of how this money grows. Part of the return on the shares is dividends. Part is in terms of the growth as well. And look, yes, they're talking about changes to capital gains tax for sure. But if you've got quality assets and quality investments that you set up for the long term, maybe you never sell them. Maybe you run your share portfolio to the 5% rule, and you just continue to receive the income. Maybe you do the same thing with your property investments as well. And so that's more on the sell side rather than the hold side. And so just to wrap on property, it is one of the most compelling strategies when it comes to growing your assets. It is, though, less great when it comes to income, and particularly thinking about fire. For example, here I've got a $1 million property based on the Australian averages, and I know that this varies a little bit based on the area and the state and the suburb and all of those sorts of things. But on average, across the country, a $1 million property, after all of your ongoing costs like maintenance and rates and strata and all of those sorts of things, will give you an income of about $27,000 each year. On a $1 million share portfolio, you're getting pretty much double the income, 54 grand, which you could get with the right investments in your portfolio. And so to say it a different way, you would need to have basically double the amount of money in property to get the same amount of income that you could get in shares. So be aware when it comes to fire and it comes to your strategy, there's two clear parts to that strategy. The first part is when you're building your assets, you're building up your asset base to the point where you can be financially secure. And then the second part is when you're living off that asset base. And know that the strategy that you use for the first section may be different to the strategy that you use for the next. That's all part of the planning process and what you need to be doing as well. Now, the final element here, I've got crypto investing, crypto and startups I put into the same bucket. I put these here as an area that is getting more and more attention. Obviously, we're seeing huge growth in the cryptocurrency market. We are seeing an increasing exposure to startup investments in the country as well. A lot of growth in those spaces. They are also very volatile, which is what we're seeing at the moment. You know, crypto markets are down 40 odd percent. Some of them even more if you're in the more speculative end of the spectrum there. And look, I think that there's a lot of potential moving forward for these assets. But in my opinion, the approach that I take personally and the one that we advocate with our clients is that you want to set up the foundations of your assets first so that you've got something that's nice and reliable, consistent. You know, you can sleep like a baby at night knowing it's sorted. And only then, and only if you're really interested in this space, then you can start to add those things in, but do it in a way where you're not compromising on your ability, though, in a way where if there was a massive market correction or things went completely sideways, that you would have to start again, because losing money is one thing, but losing time is much more expensive when it comes to compounding and those sorts of things. And yeah, I see a couple of comments here, like around capping your exposure to these sorts of investments and having no more than 5% or 10% of your assets in this particular space. Having a rule like that, once you've built your foundations, I think is something that is quite sensible. Alrighty, so I want to go through practically how you can do this, and hopefully you got some insights from the previous section as well. If you're wanting to set up to fire, like one of the first and most important things that you need to get right is your spending and saving plan. And so I get that this is not that exciting. It's probably the least sexy part of your money strategy, but it is really the most powerful. And so I'm going to talk a bit about banking, how I run my own banking, how we run it with our clients. But I want to start a little bit bigger picture so that you know sort of where this is coming from. And so essentially, if you're talking about allocating your money, you've really got two choices. You can allocate it to your spending and your lifestyle today, or you can allocate it to your spending and lifestyle in the future. Now, if we talk about allocating money to your future bucket, we're talking about savings and investments. So saving money in cash or shares, property, crypto, and then you put your super in there as well. Now, we've already talked about the downsides with saving money in cash. No one's going to get rich by saving money in cash because of the impact of tax and inflation. And so if you want to be growing your money and actually building your wealth, there you need to be investing into growth style investments, shares, property, super, crypto, whatever those things are for you. But all of those investments, they're all medium to long-term investments. They all have big ups and downs, which we see. And so the key is if you're investing into growth assets, which you should seriously be considering, if not, I don't know if I'm allowed to say that you should be doing it, but in my personal opinion, I would say you should be doing it. There's only two things that you need to do to make money when you do that. Oh, I've got some balloons here. The first thing is that you need to make sure you choose good investments. That's really critical, that you're not putting rubbish into your investment mix so that you get the results over time. The second thing that you need to do is to make sure that you're never forced to sell your good investments at a bad time. Because if you've got good investments, good property, good share portfolio, whatever, but you're forced to sell those investments at a bad time, then you're going to lose a whole bunch of money. And how you make sure that when you put money over into the future bucket and invest it, that you don't need to bring it back into that you don't need to sell it at the wrong time is you simply need to make sure that all of the spending that you want or need to do is provided for. And there's only so many types of expenses that people have. You've got your fixed costs, your bills, the boring stuff, your spending, your entertainment, walking around money. You've got debt, everyone's least favorite bucket. And then you've got your lifestyle, which is what I call your travel fund. It's essentially your savings to spend. And so one of the first things when it comes to FIRE is to lay out, okay, these are all the things that I want to be spending my money on, and this is how much I have left over for saving. Now, savings tends to come last in that case, but it's not the least important thing. And so often there's an iterative process where you go, okay, well, I'm not quite happy with how much I'm saving. In fact, if you're like me, the first time you do your budget, lay out all the spending you want to do, you're not saving anything at all. And then you have to go back and go, okay, well, how do I find a balance that I'm happy with here? Once you've got that, you've got a spending and saving plan. But a great plan on its own isn't going to get you great results. It's not going to mean that you end up saving. And so you need a system that sits around your banking, right? So you've got you've got money coming into one account, and then it's automatically going to all of the different areas so that you got the right money in the right places at the right time, so that your savings happens automatically, and so that you can spend guilt-free. And when you do that, it goes a long, long way to firstly making sure you're hitting your savings goals, but secondly, to make sure that you're able to really effectively plan. And when it comes to FIRE, your numbers are everything and your timeline is everything. And so having confidence on those numbers rather than just saying, oh, I think I can save $1,000 a month or, whatever the number is for you, it is very, very different in terms of your decision making and your confidence levels. And so savings, well, I've talked about a whole bunch of things there that it does get you there faster, but it really does dictate your investments. If you know that you've only got the ability to save $100 a week, say, for example, then you're going to have different options to someone that's able to save $1,000 or $4,000 a week, for example. So that really influences what your strategy should be. And I'll talk about that a little bit more when you get into planning. It also eliminates your guilty spending, and particularly for FIRE bugs or FIRE people, it is really common that when you get really deep into it, then I've seen a lot of people that they feel so guilty, they never end up spending any money. But if you've got a clear allocation for your spending bucket here, this should now be guilt-free spending, that you know that everything else is working and you can spend the money in there without compromising on your plan. And that I think is really powerful. Couple more case studies here. Elise and Scott, these guys they were business owners, pretty busy, had a cracking business, but they had no real plan around how they were saving or managing their money. As a result, they felt like they were way more behind than what they actually were. And so when we got into their planning, one of the first things that we fixed was around their saving system. And they realized they were actually doing a lot better than they thought. As a result of that, they ended up buying their own home and doing it much, much earlier than they thought was going to be possible. From there, they were able to invest and do that with confidence because they knew what their numbers were. Kate is another one that she was actually rebuilding her money after a relationship breakdown. And the saving system allowed her to clear out a whole bunch of personal debt in a very, very short amount of time, and then move on to purchasing an investment property, and then use the tax savings from those investments to build her investments even further. And was really stuck. And she was actually not even going to go and get advice or look at this stuff because her accountant told her that she was doing everything that she should and nothing. She wasn't missing anything. And so that's the power of, I suppose, the spending and saving piece, but also just making sure that you're taking the time to actually assess your numbers and knowing what actually works for you. And so, going back to our fire game plan, that the first thing that you want to do, particularly when you're early on in the journey here, is that you want to invest to build up your momentum. Know that leverage wins, leverage and property investing, leverage borrowing to invest wins when it comes to building up your wealth. And once you're in the property market and you've got a quality asset which is growing in value, you can actually use basically the for anyone that's not already across this, and I'm sure there's a bunch of people who are, but basically the difference between the value of an asset and the amount of money that you owe on that asset is the equity that's available. And so say you buy a property for $500,000, just to make my example easy, you buy it with a $500,000 loan, you've essentially got value of $500,000, loan of $500,000, you've got $0 in equity. But fast forward 10 years, and we know that in Australia, property doubles roughly every 10 years, so long as you choose a good one, that you've got $1 million property with $500,000 worth of debt, you've then got $500,000 worth of equity. And the great thing about property equity in Australia is that the banks will lend against that equity, so long as you can service your loan and you meet the criteria or whatever else. And you can then use that to buy more quality assets that can then grow your wealth faster. And so for me, it's one of the closest things to a free ride that you can get because you can borrow all of the money to purchase, say, another property or shares or any other assets. And then you've just got those assets that are growing for you. You can even borrow a bit of money to buffer those assets so that you're not caught short, if something changes with your work and, you've got an emergency fund in place and those sorts of things. And so it's a really powerful lever that can really accelerate things in your fire strategy. I touched on this already, but just to reiterate, shares and share investment, shares, funds, ETFs, that they win from an income perspective because of the way that the assets are and the way that property is in Australia. And know that your investing strategy will transition over time, that you go from the building phase to the income phase. And that's okay. That's natural and par for the course, but you will need to shift your strategy and you may also need to potentially restructure and change your investments around. And then the final piece here is around tax. And tax is the biggest opportunity and the biggest potential roadblock for most people because tax sort of sits underneath the surface. We pay a lot of tax in Australia and it seems to be increasing, all of the time. But when you invest, it's your after-tax return is really all that matters. It's great to get excited about it, a nice headline number when it comes to your investment returns. But if half of it's going out the door to the ATO, then your return is only half, just to state the obvious. And so most people don't think about it that way, though. And so being aware of tax and looking at how you can structure your investments to, reduce and manage the tax that you pay is going to mean that you make a lot faster progress. So to chat, and I just want to give you a few things to think about when it comes to tax and tax savings, that in Australia, we work on a marginal tax rate system. You only get one tax rate. So you get one tax rate that applies for all of your income from employment, as well as any interest income that you get on bank accounts, dividend income on your share portfolio, did I say interest income on bank accounts? Rental income on an investment property. Basically, all of your income, bonus over time, all of those things, capital gains on properties as well, they all add to give you a total assessable income number. And then that income is taxed at your marginal tax rate. But the tax rates are different for different tax entities. And a tax entity is basically anything with tax file number. I'll talk about that in a sec. And so in Australia, the marginal tax brackets I've got up here. So the first $18,000 that you earn, you don't pay any tax. Then on income earned between 18,000 and 45,000, you start paying 16% tax plus Medicare levy as well. 45% to 135 is 30%, 135 to 190, 37%, and then income earned above 190,000 is 45% on the dollar plus Medicare levy, so essentially 47%. And so, if your goal is to replace your salary with investment income, which it probably should, and particularly if you're doing that while working, which most people do because you need the employment income to actually get the assets, to get the spare cash to actually build your investments, it's likely that at some point on your fire journey, you're going to end up well in the top marginal tax rate if you don't do anything about it. And so, investing is really important, but you don't need to own all of your investments. You can own your investments in joint names with your partner, in your partner's name if they've got a lower income, in a company, in a super fund, in a trust, in an investment bond, and they all have different tax rates that apply. And so I touch on the concept of tax entities. A tax entity just means anything that's got a tax file number. So every person has their own tax file number. Every person is a tax entity. Every super fund has a tax number. That's the tax entity. And then if you open a company or have a bond or a trust, again, they're their own tax entities. And different tax entities have different tax rates that apply. And so if you invest in your personal name, all of the investment income and gains are going to be taxed at your personal MTR or marginal tax rate. Whereas if you invest in a super fund, any gains or growth are taxed at a maximum rate of 15% and only 10% on capital gains if the investments are held for 12 months or more. Then, if you own investments under a company, you pay a flat rate of tax at 30%. Then you got investment bonds. They have that two rules: that 30% tax rate maximum on income, and if you hold the investments for 10 years or more, you don't pay any capital gains tax. So bonds can be quite good for share type investing, and particularly for fire people as well. And then you've got trusts like a family trust or a discretionary trust. Whereas with a trust, the key rule is that it needs to pay out the income to another taxpayer, and that taxpayer will pay the tax. And so that the trust doesn't have a tax rate. It's where the money goes that dictates what amount of tax that you pay. And so when it comes to investing, investing is one of the biggest areas that you can save on tax. There's only so much that you can do to reduce the tax on your income at work. You can do some super contributions, you can do a bit of negative gearing, you can go buy a whole bunch of paper clips, but there is a limit to what you can do. But if you're looking to build up an investment income of $100,000 or $200,000 to fire, then there's a huge, huge opportunity in that space. And so I want to give you an example here showing how much tax you would pay on income earned through your own personal name compared to if you own those investments or own that income under, say, an investment company. And this is the same tax rate that applies for an investment bond. And so I'm just to keep my maths really round here, that if you've got an investment income of $100,000 a year, in your personal name, you would pay tax at 47% or $47,000 a year. If you own it under a company or a bond structure, you pay a maximum amount of tax of maximum amount of tax of $30,000. And so the difference between these two is $17,000 a year in extra tax savings, which is $17,000 that you can reinvest to actually grow your investments faster. So it makes a huge, huge difference to how your investments build. And if you've got more money, say $200,000 of income, the difference is $34,000 every single year. $300,000, it's $51,000. At $400,000, it's $68,000. And that's every single year. Again, money that can be growing your assets faster, helping you get to the fire point sooner, or just spending on your lifestyle today a little bit more as well. And so crazy powerful in terms of getting your entity structures in place. The tax structures become more valuable when you've got more savings and more wealth. And I've just got a little snapshot here. This is a tool that we use with our clients where we look at when they're investing, different amounts of money, how the investments would grow if they're investing in their own name, joint names with a partner, bond, company, trust. And you can see that, well, maybe you can't see it that well because the lines are quite small, but over the long term, there's a fairly significant difference with how the assets grow. And you want to sort of consider this when you're setting your investment strategy and setting your entity structure as well. And so that ties into how you can plan with your Excuse me. Um, and so what I put here, this is essentially the planning process. It's the planning process that we use when we're helping our clients at Pivot Wealth set up their plans. But it's honestly, it's the same process that every single person can follow when it comes to setting up their financial plan. Um, and so I'll step you through each of the elements in turn, and then we can tie it into some of the stuff that we've already covered here. The first step is to focus in on what's important to you. What is the goal? What does success actually look like? What does your ideal future lifestyle look like? And you can back solve for some targets to get there. The next piece is that you need to clarify all the different moving parts, the things that are going to impact your strategy. How much, what's income's coming in, what spending's going out, how much is left over, what existing assets do you have? And that gives you a bit of a baseline, or it gives you actually a very solid baseline that you can then look at decisions over the top of, which is where the strategy piece comes in. And from there, you're just looking at what are the different pathways that you can take to get you from where you are to where you want to be. Investing in shares, investing in property, own home versus investment property versus cranking your super. And typically it's some sort of combination. Each of those are going to have different financial outcomes attached to it. And each of them are going to have different levels of risk attached to it. Stress, some of them are going to be more comfortable, some of them are going to be less comfortable. And so typically what happens when we get to the strategy piece is that people see the numbers, you balance it against the emotion and how you feel, and you choose a path that you feel gives you the best balance of the two. From there, it starts getting a little bit simpler that you just need to wrap it all into an action plan to go, okay, here are the 27 steps that need to happen to take me from where I am to where I want to be and to capture all of this upside that I've planned for. And from there, you want to try and automate as much as you can, automate your investing, automate your saving, automate your debt reduction, automate your super. And then you've got the track to run on. You've got a great plan, you've got a system that sits behind it. And then it's about ongoing execution because we know that what's going on with your money will change, what's going on in the world will change, and how you feel and what's important to you will also change. And so as those three things change, you want to make sure that you're refining and updating your plan to make sure that it actually works for you. And planning when it comes to your money is something that I believe you should do at least once a year, but also when anything really significant changes when it comes to your money as well. And so when it comes to putting together your fire game plan, you want to balance the numbers against the emotion. The numbers are important and the upside is important, but the emotion, how you feel, your stress levels, they're also important. And finding the balance between the two is key. To do that, you need to prioritize. So your prioritization is really critical. And look, one quote that I love from James Clear, who wrote the blockbuster Atomic Habits, is that you don't rise to the level of your goals, you fall to the level of your systems. And I think it's great to have great goals when it comes to your money, particularly at this time of year. A lot of people, New Year's resolutions, are all pumped up and running on a high around that. But if you've just got a goal and you don't have any system to back it up, you're much less likely to get the results that you actually plan for. And so moving forward from here, you want to focus on how can you systemize your success. Alrighty, guys. So I'll bring this sucker home, and then I'm going to get into Q&A. If you guys have got any questions that you want to make sure that get answered, just pop those straight into the Q&A box as well, and I'm going to come to them in a sec. But look, guys, we've gone through today, and I sprinkled a bunch of case studies in there. But the reality is that only one case study really matters, which is yours, which is what's going on with your money. And so, what are your homework from here in terms of? I hope you guys have got some great ideas. But we know that if you want to turn those ideas into more money in your bank account and better outcomes, you need to take action. And so the questions that you want to ask yourself from here is, what would an epic result look like over the next 12 months? What would that actually look like for you? If it's the 31st of December, I know that's not exactly 12 months, but you're looking back and say, wow, I absolutely crushed it this year. What does that actually mean for you? And then you want to look at, well, what are the areas that you're going to prioritize and focus on over the next 90 days? Because there's always so many things that you can do when it comes to your money. You can work on your tax and your saving and your investments. But the reality is that there's only going to be a much smaller number of things that will move the dial more than the others. And one thing that I've learned for myself with my money and also in business is that there's only so many things you can focus on. If you prioritize and pick the thing that will have the biggest impact, you'll get it done faster, you'll get a better result in that area, and then you can move on to the next thing. And that's super powerful. And so look at what those areas are. know that, I've got this quote here from Derek Sivers that says, if information was the answer, we'd all be billionaires with perfect abs. You don't need more ideas or more information. You need to take action, and if you want to get to results. And so, look, I'm going to come to these questions in a sec, but guys, this is exactly what we help people with at Pivot Wealth. We're actually booked out for the remainder of February, but our March intake is opening up shortly. And I see now, I know that we're only in February, and June might sound like it's far away, but this is really the last serious chance to nail it with your tax for this financial year and get on the front foot to minimize your tax position and maximize how much money you can build from an investment perspective. And so, in terms of how we work with people, when we're doing plans with our clients, the first thing that we do is that you decide on what your focus areas actually are and focus on the things that are going to move the dial. They give you the confidence to act quickly, and then you set up the systems to make things simple so that you essentially automate your success. Now, we do these 45-minute, we call them money breakthrough sessions, where you essentially deep dive on your targets and roadblocks and cover some of the money success principles and also how you can plan with your money. We charge 147 bucks for those sessions, but we actually donate that money to charity. That's our way of giving back and also meeting a whole bunch of new people. We donate our time, you put in a few bucks, and everyone wins. And you essentially walk away with clear focus on what you can do next to move the dial, whether you choose to use us, do it yourself, or use someone else. Now, we only invite people to those sessions when we know that there's going to be value. And so we've got a taco guarantee on this, that if you do one of these sessions and you don't get value, we'll cover the cost of your session, plus chuck in an extra 10 bucks for you to buy a plate of tacos next Tuesday. And so we do this quick 10-minute screening call to make sure that there's a fit before we get into those breakthrough sessions. And so I've actually just popped the link into the chat box for anyone that's keen with that. But basically, it's a quick fit check, talk through the opportunities, give you the opportunity to ask a bit of Q&A, and then understand your next steps and lock in your action for 2026. So if you're interested in that, you can check it out. You can click through the link in the chat, or I'm going to pop the QR code on the screen as I go through some questions. Alrighty, so look, I saw a couple come through here. So we've got one here around would super investments with after-tax contributions and being liable for Div 293 still taxed at 15% for income and gains? And so that's a little bit of a complex one, but essentially, when you're putting money into your super fund as an after-tax contribution, it typically doesn't get captured under Division 293 because it is an after-tax contribution. So for anyone that's not already across this, Division 293 is the high income earners super tax. So once your income goes above $250,000, they tax you at an extra 15% rate on all of your concessional super contributions. So that's basically salary sacrifice and employer contributions. But if you put in an after-tax contribution, then that's not subject to the same amount of tax. So I think no is the answer around that. I hope that helps, Adrian. Got one here from Nathan as well that says, if you invest under a company, it doesn't get the CGT discount. Is that correct? Yes, 100% that is correct. And that's one of the trade-offs for investing under a company, that a company has a flat tax rate of 30%. And so you would pay a tax rate of 30% on all capital gains. Now, if you invest in your personal name and you have an investment, the 50% CGT discount, essentially, if you've got a significant gain, that's going to put you at the 47% tax rate. The discounted tax rate is therefore 23.5%. And if you've got 30% in the company, 23.5% in your personal name, it means that you're paying 6.5% extra for investing in a company. So you do really need to run your numbers and understand the strategy before you jump in. Where you are, though, investing into long-term assets, like say, one of the real popular Aussie share index fund ETFs, like that's potentially an asset that you could hold forever and never sell because it's rock solid, it does its thing. And so perhaps the CGT discount doesn't really matter. And if you've managed to not pay tens of thousands or maybe even hundreds of thousands of dollars in tax as you've been building up your money, then is it really that much of an issue, even if you did pay a little bit of tax in 20 or 30 years' time? For me, and I've got a bunch of investments under companies, although I do have a business, which means that I get an extra, it means that I don't have to draw money out and pay tax personally. To get it into the company in the first place. But I've ran the numbers, and for me, it's way better for bit elements of my strategy to be using a company structure, even though the capital gains tax discount is not in play either as well. So I hope that helps, Nathan. Got one here from Bell says, what's the best approach structure as an employee? Structuring is quite limited, perhaps a separate trust company for investments given can't stream personal income from employment? Yeah, that's a great question, Bell, and that's exactly what I was sort of referring to when I said that there's a limit on what you can do as an employee and how many tax deductions you can get. But when it comes to your investment structuring, then essentially the sky's the limit. It's just limited by how much your investments are going to grow and how those assets will build over time. So typically, and this obviously is not financial advice, and you should definitely go and seek that out. But if you're setting yourself up and you're trying to, achieve a really strong financial outcome into the future, then then having some tax entities outside of superannuation is probably part of your future, whether that's an investment bond, a trust and company setup, or whatever, because it gives you a lot of flexibility and a lot of tax savings are actually up for grabs. You want to do that with your eyes wide open. So make sure that you understand the rules, the ins and outs. You've got some good support around you before you jump in and do that. But typically, if you're on a stronger path or you're aspirational in terms of where you want to get to, you want to be looking really closely at structures and also trying to doing it sooner rather than later, not too soon, because you want to make sure the cost, if you're setting up trusts and companies, you want to make sure the cost is always less than the benefit that you're getting. But you also don't want to leave it too late. That if you build a massive share portfolio, you might be sitting on big capital gains, and then it can be really expensive to restructure things to get to the point of tax savings as well. Hope that helps. One here says, as a single person, small family, what's the consideration for tax structure? Limited people to distribute money to. Yeah, look, that's a good point. With a trust, then you can distribute to family members, but you can also distribute to your own private investment company, which essentially allows you to cap your total tax at a rate of 30%. So even if you've got no beneficiaries, no partner, no kids, or no adult kids, it can still be beneficial. You can also consider looking at things like investment companies where there is no requirement to distribute money in those sorts of cases. They're generally also a lot less expensive than setting up a whole trust and company type setup as your assets build as well. So that's another option to consider. I hope that helps. Got one here from Anita says, can non-tax residents, so an Aussie living overseas for work at the moment, withdraw equity from an investment property to bolster an ETF portfolio? Look, that is a slightly complicated one. And I believe that if you're looking to draw equity out of a property, then you need to satisfy like lending standards with the bank. So you'll need to go through like a mortgage application process. And so it will depend on where you're living, that they sometimes will like shade different companies' incomes. Like we had a client recently that was living in Bali, and they basically would only count like 80% or 70% of his income, because the currency can be a little bit more variable or whatever. But generally, yes, it's certainly possible depending on the circumstances. I would say to chat to a good broker. We've got some great brokers at Pivot. If you wanted to chat, you can drop us a note on that as well. But you would want to also do that in conjunction with your tax accountant so that you understood what the tax implications of that actually were as well, if you're not already 100% across that. So look, I hope that helps, Anita. I'm just going to take one more question because I am really mindful of the time here. I've got one that says, if your investments are housed in a legal entity and your shares are in a legal entity, Are your shares in that entity a CGT asset? In which case, if I was to move overseas and stop being an Australian resident, that triggers a CGT event, not on the underlying investments, but on my shares in the Investco. Uh, an investment company you would typically see owned by a trust structure is one thing, and then a trust may have a trustee company. Um, So typically not is the answer to that, but I would say that's obviously a little bit out of the box. And so I would strongly encourage you, if you're thinking about making those moves now or you're thinking about relocating, then I would strongly encourage you to seek out some advice before doing that to make sure you got your I's dotted and your T's crossed. Awesome, guys. Well, look, thank you. Appreciate all those questions coming through. Feel free to hit me up on socials if you got a question that didn't get answered. Apologies for anyone because I saw that there was quite a few come through. We also have a bunch of events coming up. We've got one coming every couple of months with the guys over at Sharesight. So get around that on our Eventbrite page. In the meantime, guys, though, happy investing. Stay safe out there, and I'll catch you next time.